So why don't we go ahead and get started? This is a subject that I've presented on before. I'm very passionate about it, and I noticed I was just peeking at a couple of one of the conversations that was going on before I jumped back into the presentation here about position traders, longer term hold, things like that. And one of the ways in which I try to provide some value to the trader community out there is by presenting on some topics that aren't talked about a lot. And one of these is Forex diversification. Now, I try to make sure that every time I present on this particular subject that I'm presenting some new ideas and some specific ideas as well. And I have a strategy. I have a strategy that I'm going to be covering specifically in this particular presentation as a way to illustrate my point. Now, I like to spend a lot of time on the charts, but before we jump to that, I just wanted to discuss a couple of specific topics that just to set up the discussion a little bit better. Now, before I do that, I wanted to make sure that everybody has seen my email address, john@pfxglobal.com. You can, if you'd like a copy of the presentation, or if you want to just ask me a specific question you didn't get a chance to ask while we were talking today, you're welcome to send me an email. I'm pretty good at getting back to people. Additionally, this is the web address, so it's www.pfxglobal.com. We have a lot of education there. It's all free. There's no catches or anything like that. You can just go check it out on your own. We have a number of courses on Forex trading, Forex options trading, etc. Okay, so let me move forward here just a little bit and talk about diversification, because this is something that a lot of traders will kind of get a bit hung up on this. You know, diversification, or the word diversification, has something of a stodgy, I think, connotation. People think about diversification as something that you do in your 401k. If you're here in the US, you know what those are, or some sort of a retirement account or something like that. It doesn't really have any place in the Forex. But I would counter that with, in fact, it definitely does, because the whole idea behind diversification is not really, are you conservative, therefore you're diversified, or are you aggressive and therefore not diversified? It's diversification is just as applicable to very aggressive traders, and I have a specific trading system that I would kind of contrast with other trading systems I've talked about in the past that are very long-term holds, with something that's more of a mid-term hold. So getting even a little bit more aggressive than you might normally think about with a diversified portfolio. The reason why it's so important is I'm convinced that as many times as I've seen traders talk about, entry signals and different trading systems, et cetera, that the most important thing that you can do, because you have the most control over it, is to manage your risk. And that's what diversification does, is it helps you to manage your risk. So, as you'll see this little definition here, if you were taking a peek at that, the whole idea is, of course, is to try to get your total portfolio to outperform any one position. And the way in which you do that through diversification is that, by definition, what you are is you're really deployed in several positions at the same time. Now, there are a couple of tricks there, though, that you need to think about, and I'm going to show you a couple of examples in order to effectively diversify and make sure that you're getting those benefits in the first place. So I have a couple of examples that I think will help not only look out for some of the pitfalls that traders find themselves into when they are first learning to diversify their Forex holdings, but a couple of a specific way in which you can think about diversification as you evaluate your positions, position by position. So the idea, of course, is your good performers offset your big losers, so that those price shocks or those declines in your overall portfolio value are not as significant, which ultimately leads to a smoother equity growth by avoiding those price shocks, because you're not having to make up as big of a difference on the way back up again. Now, one of the reasons why I wanted to discuss this particular topic today was I've been watching the market. So I've have pretty open relationships with senior managers at several brokers and in the stocks and options business, and in the dealing business as well, the spot forex. And one of the things that everybody knows is going on right now, since about September-ish of last year, is account values overall are going down really fast. So this is a big concern, and part of one of the big culprits here that everyone agrees is traders are not using any risk control. They're just getting whipped to death. So they're setting very tight stops, thinking that is equal to risk control, which it's not, and ultimately are just getting their account whipped back and forth. So if you find yourself struggling with this, now I recognize not all of you are, but if you find yourself that you are struggling with this and you find the last few months of trading has been tough, then this may be something that can really help you. Okay, so one of the things that I did want to talk about, and I don't like to get carried away with stuff like this, but one of the reasons why this isn't talked about quite very much is it is a conspiracy against you. Just as I mentioned before, you'll notice that with public brokers, for example, you can get their information. They release their information all the time. One of the big pieces of information that they're graded on by the public market, if it's a public dealer or broker, is transaction volume. How fast are they churning their accounts? So, some of the things that I always tell traders to look out for is, if you're working with a broker, do you get charged inactive account fees? If you're not meeting a minimum trading volume every month, do you get, or every 90 days or whatever it is, do you get billed for that? Because that may mean that they're not aligned with you, and they may be marketing to you something that's very much in their benefit, which means big leverage and lots of trades. So that's a very short-term benefit for them. And it's something that I always tell traders, look out for that, because the service provider's interests are not always aligned with yours. So when you start thinking about risk control as something that you're going to implement into your trading strategy, into your portfolio strategy in general, I would say it's a good idea to have a conversation with your broker and say, hey, what happens if I hold a position for a month as an effort to diversify out some of the risk in my portfolio, and see what they have to tell you. The other thing that I would also mention is that there is a big difference between the futures market and the spot market, and most traders who trade between the futures market and the spot market spend a lot of time debating which is better. I would include myself. I've even given a presentation on, what are the relative benefits and advantages of futures versus spot? Spot has one very significant advantage, and that is flexibility for small account sizes. If you have a smaller account, spot trading, so trading the spot Forex, meaning you're working with a dealer, it has a lot of advantages. If you don't have that constraint, if you have a little bit larger account, the futures market is great for a number of reasons. Typically, pricing I have found is a little bit better. Even when you include commissions, so your trading costs are a little bit lower. But in addition, the product breadth that you have available to you is much better, which is a important thing to consider when you think about diversification, because one of the best ways that you can diversify is to try to get into more than one asset class. Here's an example. This is my very crude drawing of an asset pyramid. So unlike a pyramid scheme, by the way, an asset pyramid is a way to think about how you're diversifying your assets in order to try to leverage the capital markets, because not all capital markets perform the same at all times. So now this is only an example. It's not a recommendation. But what I want to do is to get you thinking about, okay, how do I start to think about the capital markets as something that can improve and offset risk in my Forex portfolio as well? So, for example, what I've done is I've printed, here's my allocation. Here's the way that I look at it is I've got stocks, about 40%, bonds and fixed income 30%, commodities 15%, and Forex investments and trades 15%. The idea is that, of course, when one market is trending very aggressively, another market is probably channeling. Across the majors right now, we have some pretty extreme channels in the Forex. But we've had some pretty nice performance in commodities. Even fixed income has actually been, there's been some nice opportunities there with interest rate futures. So I want to answer one question or one comment that just came up from Rama. In spot trading, you can hold your position for an unlimited time frame, while in the futures market, you have fixed time frame constraint because a futures contract expires. That's a good point, and it's something that you have to consider. One of the things that I always say is in the futures market, typically your front month is anywhere from 30 days to 90 days. So you do have quite a time frame in which to hold that position before you'd have to roll it over, quote unquote. But it is a good point, Rama. You can theoretically hold a spot position for an unlimited amount of time. And I find that a lot of traders will actually try to take advantage of as many products that they can in as many products as they can in the spot market because of that advantage. The one caveat that I would say is just make sure that you really can hold it for an unlimited time frame and that you won't be charged fees for holding it for a long time frame. That's something that I find catches a lot of traders by surprise. So the rationale behind this particular asset allocation table here, or asset allocation pyramid here, is not necessarily that this is that there's a logical reason why stocks should be twice the weight of Forex. I used it only so that I could use a real life example. This is what I do. The real takeaway here, the real rationale, something to consider, is not that stocks should be twice the weight of Forex, for example, but is that you should think about more than one capital market at a time, that there is opportunity outside merely being in one capital market where your market exposure is much more concentrated. So as we start talking about, continue our discussion about diversification, there's a process that I go through where I think about how I'm going to execute this by coming up with a strategic idea, first of all. So it's not so much something that I'm approaching from the perspective of, okay, I want to find five different currency pairs, and now I'm going to figure out how to trade those five currency pairs. I find that it's a little easier to try to approach it from the idea of, let me get the strategic idea first. Let me figure out what I'm going to do first, and then start pulling the currency pairs that best fit that particular strategic idea. So that helps to kind of reverse the order in which you think about this. That it's not diversification that comes first. It's what comes second, following this what you're considering as a strategic idea. Okay, so you should be able to see my charts, and this is a pretty obvious example, I think. And this is probably the biggest caveat I would give to traders who are looking for a way to diversify their investments. And I pick on this one actually because I get this question all the time when traders want to take advantage of, there's a very popular strategy. It's been a little troubled lately, but there's a very popular strategy in the Forex, the carry trade, right? And so what I'll find is that traders will get overweight in trying to maximize the carry trade by shorting the yen only. So and I would say that this is a problem whether they're just trading one particular currency pair like the pound yen, or whether they're trying to quote unquote diversify it across more than one different currency pair. So in this example, I brought up, of course, the Aussie yen and the Euro yen, and as you can see, they look virtually identical. This is if there were one thing that I was to tell new traders who are thinking about diversifying their portfolio, so if they have a strategic idea, and I use the carry trade as the example, and they say, I really do need some diversification, some risk control here. One of the thing that I would say to avoid is make sure that you're not investing in assets that are too highly correlated. Let me give you another example. So I'm gonna close this. I'm gonna open another, and what we're gonna do is I'm gonna look at I'm going to look at a an example from outside the Forex for just a second, okay? To help make this point. I've got two charts here. These are stock charts, by the way. So this one on the top that my cursor is looking at right now, this is Delta Airlines. For those of you who are familiar with the U.S. airline industry, what's been happening since about 2007? It's a nightmare, right? And I used this example recently in an article that I wrote because I thought it was pretty dramatic. So since about over the last year or so, Delta Airlines has been declining significantly. Well, so has this other chart down below here. This is actually Southwest Airlines. Now, the difference is, however, so both of them have been performing poorly. But what happens is that there are ways to think about diversification. And this was something that I hinted at before in the introduction when I was saying, there's a way to think about diversification when you're evaluating one asset versus another to help avoid some of the problems that may come up when we're just evaluating the majors. So when we're just looking at the majors, sometimes we can get a little myopic, a little bit of tunnel vision. Here's something that stock traders will do all the time, and I think the exact same thing is true and very applicable in the Forex when we're dealing with the crosses. So what will happen is that traders will look at the airline industry in general and they'll say, well, the airline industry stinks. It's terrible. But we know that Delta is way worse than Southwest. So Southwest may have their problems, but they certainly don't have Delta's problems. So imagine that what you had done in July, so a year ago, you had shorted Delta and then gone long Southwest Airlines. The idea is, of course, that the more fundamentally sound stock is going to improve faster if the market goes up, or it's going to decline slower if the market goes down. And by doing that, shorting one stock and going long the other, what you really did is, by the way, that would have worked out to be a $14 gain over the last year, which is a pretty nice return, actually. That's about a 50% return on a stock trade with no leverage at all. That's not too bad. So the same concept. The reason why I tried to use I wanted to use a different example from a different capital market to just kind of make the point that that's essentially what we're doing when we're trading currency pairs. We're shorting one pair. So, for example, here I've got the Kiwi dollar, and I'm going to bring up the Aussie dollar. So these two particular currency pairs are pretty highly correlated, and both the Kiwi and the Aussie. Now they're not identical. If we try to line these charts up a little bit, you can see that same price shocks, similar trend, a little bit lower decline, a little bit more of a decline on the Kiwi, but not as much on the Aussie lately, but still a consolidation in both cases. But the problem is that investing in both of these currency pairs is quite a concentration in the dollar itself. Whereas, one thing that we do know about what's going on in the Forex right now is that the Aussie has been outperforming the Kiwi for a while. And as I talk to traders these days, it's a question of, gosh, everything is channeling so much, it's tough to grab the trends. Well, the trends are available. It's a matter of how we're thinking about it outside of the majors. So here, for example, this is the Aussie Kiwi, which broke. They had a really, really tight correlation, which kept this particular pair in a channel for a long time, but was broken quite a while ago. And since then has been it's subject to fairly extended long-term trends that can turn into quite nice opportunity. So it's one way to think about diversification from the perspective of a trade-by-trade basis and getting my head out of the majors and into some of the crosses, which are just by pure volume. We know that very, very few Forex traders are spending any time in the crosses because there's such a small, insignificant percentage of total trading volume, and yet that's oftentimes where the best trends are. And one of the most effective ways to try to diversify out some of the real uncertainty in the market, including, for example, the volatility associated with the dollar, and you could say the same thing about the yen and even the euro to a great extent, I find. Okay, so let's change the subject here just a little bit, because one of the things that that I've discussed in the past is these are topics that we've talked about in the past, as far as diversification, how to get into more than one market, how to get into more than one asset, what kinds of things to look out for, etc. But one thing relative to diversification that I don't find a lot of people talking about, and yet is probably one of the most powerful things you can do, and is in fact the specific strategy that I wanted to talk about today with everybody that could be implemented today, is diversifying in investment instruments. So in other words, I find that traders oftentimes look at Forex trading or stock trading or whatever it is as long and short. So, for example, in the Forex, you're either long the Forex currency pair, or you're short the currency pair, or in the stock market, you're buying the S&P 500 or whatever it is, or you're shorting it. And however, the problem with that is that it ignores some of the advantages that are available to traders in any market, but and that includes the Forex. Now, I brought up, just to try to bring a little variety in and introduce you to some new things that you may or may not have seen before, I brought up two charts. One is the stock symbols, or the index symbol rather, is PUT. The other one is the SPX. So if you don't know, the SPX is the index for the S&P 500. So it's a good proxy for what's going on with equities in the U.S. So these are the 500 large cap stocks. And of course, we've had a lot of volatility. If you go from 1998 to today, there's been basically no growth. But I think right now today it's hovering at like 5% or something over the last 10 years. So really it's an argument of, gosh, why would anyone want to be long equities? And I totally agree with that. And it's something that I get a lot of feedback on. People will say, well, the problem is that the SPX itself, it's 500 different stocks. That sounds pretty diversified. How is it translated into a benefit? That's hard. That's a hard question to answer, because it's like, well, you haven't lost everything, but you sure haven't gained anything either. So this is where using the full suite of products and tools available to traders really comes into play, because this chart just above it, this is PUT. What this index does is it's the S&P 500 as well. But what it is, instead of buying those 500 stocks or what have you, you're selling an option against it, specifically a put, which is a bullish trade, because what you're basically doing is you're selling the right to someone else to sell you the stock or the index in the future. But in this case, what you've done is, when you sell options, what you're really trying to do is you're taking some risk out of the market, and you're being compensated to do that. Well, when you sell an option, you actually don't have to be right on the ultimate direction that the market is going to go. The market could stay flat, it could kind of go against you a little bit, or it could go the direction you forecasted and you wind up profitable. You only lose when the market moves a lot against you. So it's one of these things that, while you certainly will have losing periods, such as this one did in 2001, 2002, the difference is dramatic. In an unleveraged these are two unleveraged portfolios. The put portfolio has increased in value by 100% over that same 10-year period. So 0% down here, same asset class, the S&P 500 in both cases, but in one you're selling puts against the S&P 500, in the other one you're buying the S&P 500 itself. So I wanted to just kind of mix it up a little bit to show how this works in other capital markets, because I find that oftentimes traders are not aware that the capital markets they all pretty much look the same way. If a strategy works in one capital market, typically it's going to work in another capital market as well. Okay, hang on. I'm going to bring up a series of currency, and I'm going to share with you a strategy that I play myself. And I'll explain this in as much detail as I can, and I'll show you how to get some more information if you'd like some. So here we're looking at the dollar yen, and I just saw analysis that I totally agree with. We're looking at this uptrend, but as much as I would like to be bullish on the dollar yen, I'm having a hard time with it, because we're stuck at 108. We just cannot seem to break through this level. And as attractive as it seems that there might be some opportunity here, it just really seems like it is unlikely that in the short term the dollar yen is going to be able to break up above 108, even 108.50. It seems just really unlikely, because that resistance level is so significant. We've been stuck here for going on a month now. So it's interesting that hey, thanks, CVJ. So what do we do here? Do we go long the dollar yen? Do we go short? I mean, it's I don't think going short is a bad idea. It's just that we've got this long term or we've got this intermediate term trend here that we'd be kind of fighting. So I look at it from the perspective of, well, it's a weak trend, so it may be better to just go elsewhere to find long and short trades. But what we could do is sell an option, because what we do there is, so for example, I've got a line just drawn right across your resistance. One of the things I look for is I look for the trend, and then I sell an option that's against that, or that's in cooperation with that trend, if you will. So in other words, in this case, I would be selling a call because that's a somewhat bearish thing to do. What I'm hoping is that the market does not go beyond 108. When you sell a call, you get paid a premium up front. In this case, by the way, if you're selling a call with about a month left before expiration, you're going to get about 100 pips worth of value. You're going to get paid about 100 pips worth of value, which puts my break even up around here. So as long as the market doesn't go beyond 109 in the short term, I'm in the money. And it's the same idea as meaning I'm in the money as in I'm making some profits. It's the same idea as that's being used by traders in the S&P, where they're selling puts against the S&P because ultimately they're trying to take advantage of the uptrend on the S&P, but they don't want to have to to sustain all that market exposure, so they're diversifying their trading by pushing into a different asset class or instrument class. So they're and in this case, I'm looking at the Forex as my asset class, but I'm using another instrument class to diversify out some of my risk, and that being options in this case. So I could go down the list here. Let me snag another one. This, by the way, this list that you're looking at right now, this is my list of currency pairs that I sell puts or calls, depending on the trend, against every month. So just depending on what it is. Let me show you one more example. I think we'll make a... We'll do the euro. This is a good one. Okay, so the euro is a good example. Right now I'm overall, although the euro's been consolidating, it's a little bit different Forex champion. It's very similar to the covered call strategy, but in this case I'm just selling the option itself. I'm not holding the underlying spot position, long or short, to offset it, but it's very similar concept here. So in this case with the euro, what I'm trying to do is to determine where is the euro likely to not go. Where if I'm moderately bullish, in other words, I think that the euro is probably going to go back up to resistance here. Whether it goes beyond resistance or not, that's a good question. But overall, the prevailing trend is still positive. And one of the ways in which I define the trend is I'll look at the COT report. So I'll look at where institutional investors are balanced in the futures market. So if they're net long overall on the euro, then I'll kind of stay net long myself in this particular trade. And in this case, so if I'm a little bit bullish, that means that I'm selling puts, because once again, I'm accumulating. Now in this one, the premium's a little bit better. So if I'm selling a put at 56.50, I've got 150 pips to the downside worth of value that I'm being paid to take that risk. So the market could fall down here, and that's where that's about where my break even is. So I'm building in a little bit of margin, because what I know is that the market is going to be volatile. I know that one of the ways I can take advantage of that volatility is by selling options that are outside the range of where of where the market is likely to go in the short term. So in fact, I would summarize one of the big benefits here of diversifying into different asset tools. So in this case, not only looking at the Forex market as an asset class, but mixing in option strategies to try to develop diversification on a tools basis or an investment tools basis. Because one of the big benefits is, the question is, well, with a put or a call, you only have to be right once instead of twice. If you're selling a put or a call, if you're buying, then you have very similar. You have to be right in both time and distance. So in other words, you have to have the right direction as well. But when you are selling an option, when you are the option writer, you get paid the premium up front. What that means is the market could stay. So the euro could stay flat. It could go up, or it could even decline a little bit. And as long as it doesn't cross this line, I'm still going to be profitable. So you're not sacrificing return at all. Here's what you are sacrificing. You're sacrificing volatility. It's the same reason why I contrasted that index that assumes that you're just selling or writing puts on the S&P 500 versus the S&P 500 itself. The returns, the trend of those returns looked similar in a lot of ways. The difference was the downturns were much less significant and the upturns were much more important. So the same concept works here, but it's the takeaway is it's not just a matter of diversifying across asset classes or even different assets within a class. So looking at multiple currency pairs and even multiple capital markets, but it's even a question of developing strategies that utilize different different investing instruments, so options and the outright spot position itself. Okay, so I'm going to pause here. I want to give you a couple of things. So if you find this interesting, you want to learn more about, how to, if you're unclear as to how to write an option, or why it is that you get paid up front when you sell an option rather than getting paid when the market moves, like you would in a long or short spot position. We have a number. I've actually done a couple of presentations here on FX Street that you can check out as well on that particular topic. But you can go see it on the site. We have a whole we have a whole section or a whole course on Forex options, and I go into quite a bit of detail on selling options. So you can check that out, and it should give you plenty of information to be able to start paper trading this particular strategy, so you can get an idea as to how does this work and how can it ultimately, the big goal is to turn our equity curve into that real flat curve we saw on the counter asset to the S&P 500, and that is a nice smooth growth in total return.